Pramod Degde to present a bouquet, floral bouquet to Narendra sir as well as Kota Srinivas sir. Better? Oh. Thank you. Members, I have a proud privilege to introduce the speaker for this evening, CA Narendra Jain, an advocate. He is a commerce graduate and a FCA. He is also a company secretary and holds bachelor's degree in law. He currently practices as an advocate in Karnataka High Court. Narendra Jain has experience over 19 years in advising clients and handling tax litigations in income tax, transfer pricing, corporate tax, international taxation, and GST. His academic distinctions include All India 5th rank in Company Secretary Income. He was also a writer in CA Conference. He has authored or co-authored following books: authored book on analysis of transfer pricing judgments published by CCH, co-authored book on digital commerce, an analysis of taxation aspects and emerging issues published by IFA Bangalore subchapter, co-authored book on permanent establishment emerging trends published by CBC and Taxman, co-authored book on new age assessments, penalties and appeals published by KSCAA Academy of Direct Taxes, etc. His teaching includes teaching for CA final students on direct tax, international taxation, transfer pricing from 2004 to 2018, and for the CA final students at ICI Bangalore. Thank you. I present before you to Narendra. Correction. Kota Srinivas sir, our CPM member, would like to address you. Thank you.
Sabhage namaskara. Good evening to all of you. Of course, I will not be addressing for so much of time. In fact, I had some work in the institute. Vice Chairman said there's a conference happening. So I thought I would just come and say a few words about it. In fact, from yesterday, we were all attending this 2 days conference. We have heard various topics of local taxation. The last session is on international taxation. So it's a capsule of all the laws that we learn within matter of 12 hours. Well, on the CPE perspective, before 31st of December, all of you should complete that review of CPE. And now this is a calendar year. There is no question of carrying for next year or carrying brought forward from previous year also will not be applicable. From this year it is calendar year 2023. I hope all of you would have completed required CPE hours as such. Coming to the topic, my friend who is here to talk about tax issues on cross-border employment. Many of us would have faced these issues while doing our practice. But, there may be a situation where a resident works for 3 months or 4 months outside India and he will balance these months will be in India. 4 months outside. How to handle in our day-to-day practices would have seen. But there are many instances maybe and he will take you through all those issues maybe. So there may be various issues how to compute their taxation, how to take the tax credits, and now he was mentioning that there are a lot of amendments with respect to even the dual citizenship. If you see the DTA's Article 4 deals with dual citizenship for individuals. When once a person is considered as a resident of 2 countries, then you have to decide based on certain parameters whether he is a resident of one country or another country. So those issues are also there. He was while informal meeting, he was talking about, he was telling about there is recent judgments where there are some more insights about dual citizenship. So I hope he will cover all those things. And you have been enjoying this 2 days conference. And you are there today
till the last session. I think I should appreciate all of you attending all the sessions of this 2 days conference. In fact, when this was announced and the registration started, we rejected the registration because whatever the capacity, some 900 capacity is there, we could take only 900. Many members applied afterwards, but we said we cannot accommodate you people. So those of you who are there from yesterday till now, I hope you have got a good insight of various laws. In the last capsule, I should say, is tax issues on cross-border employment. With these few words, I now request my friend Narendra to take over the presentation. Thank you.
Good evening, members. Thank you, Kota sir, for summarizing it in a nice way about the session. I would like to start the session by thanking Bangalore branch for giving me this opportunity to share my views on this interesting topic of cross-border employment. As we have seen in the last few decades, with movement of human capital across countries, across geographies, the tax issues that arise with dual employment, dual residency, lead to dual taxation, and sometimes it could be a situations where there is no taxation in 2 or 3 countries. So there is a lot of evolving happening around this law, and there are recent amendments which have been done by Finance Act 2021, and also some international principles that will help us to understand this law in a better way. The international scenario in terms of startups, in terms of technology, in terms of movement of people, even maybe movement due to economic reasons, wars, migration, all that also add to complications in this scenario. And COVID-19 also added a layer of complexity because there were forced stays in a particular geography because someone had gone for a business visit and he had to stay there. This leads to, say, a residency in that country. It could lead to a permanent establishment in that country. And these are the level of complexities that can arise. Though these may not be common for many people, but we will see very peculiar cases and very interesting cases that happen. As we will discuss during today's session, at least some interesting global decision, one Australian case, one UK case, and one Indian case also, where people have stayed in multiple countries during, say, a span of 5 to 10 years, and how does that lead to tax complications. So, movement of employees or human capital typically will have implications in multiple fields: income tax, FEMA, visa and other rules and regulations, indirect taxes, GST, social security regulations. But focus of this presentation will be on income tax issues. And even under income tax, we have multiple issues. So we'll try and cover as many areas as possible in next 90 minutes and try and cover as many interesting issues in next 90 minutes. To start with, let's brush up our basic understanding of what is scope of total income. And this also becomes important with recent amendment to the definition of not ordinary resident in section 6.6 effective from AY 21-22. So as we all know, the scope of total income is dependent on residency, which gets classified into 3 categories for individuals: resident, non-resident, not ordinary resident. As we all know, resident is taxable for his global income which arises in India, deemed to accrue arise in India, or income which is deemed to accrue arise outside India or accruing arising outside India. Even the global receipts received in India or received outside India become taxable for person who is a resident and ordinary resident. Now, person who is a non-resident naturally has that benefit under the law that his only income which is accruing or arising in India or deemed to accrue or arise in India is taxable in India. Naturally, receipt in India or deemed to receipt in India is also taxable. We leave that aspect aside for a moment. Then comes the third category of not ordinary resident. As we all studied, in this category it is taxed similar to non-resident, that is income deemed to accrue or arise in India or accruing or arising in India. But an additional item of taxation is business controlled from India or profession set up in India. So this is one additional item which becomes taxable. Now suddenly with the amendment to 6.6, two new categories are added in the definition of not ordinary resident. And these could be a lot of people who move out of India for a job who could fall in this category if the conditions of the section 6.1 and the new section 6.1a is satisfied. They may be falling in this category of not ordinary resident. We'll try and understand that. So this category will become important as we go forward. And as we know, the scope in case of not ordinary resident is business controlled from India and profession set up in India. What are these two terms? Which becomes very important. Now, profession set up in India. So what does it mean is it should be set up in India. The profession should be established in India. It is not a continuing activity, it is set up. So when it was first set up, it should be set up in India. And when we say controlled from India, that means the business is outside India, but it is controlled from India. It is not business in India, it is business which is controlled from India. That means business which is outside India, but which is controlled from India. So these are two important phrases which we have to keep it in mind for not ordinary resident. And given that the wider category which we have today of not ordinary resident, this is something which we have to keep it in mind, because for individuals this could be one additional item of taxability which can arise. Now, coming to section 6 for individuals, section 6.1 would say two standard conditions as we know, and historically our provisions for residency has been based on physical presence. That means the stay should be in India, the person should be physically staying in India. Now we have also, we will see in 6.1a, where we have moved from physical stay to citizenship. So in certain categories, a citizenship may trigger residency. Now, other countries already had that concept, but in our provisions, right from 1961 till date, we always had the residency test based on the physical presence. Now that physical presence had two conditions: 182 days, that means if you are crossing 182 days during the previous year, and the second condition was 60 days plus 365 days in 4 consecutive years. So these are two conditions that we have. So if an individual stays for 182 or more days in India, then he becomes resident in India. There are added complexities on how do you calculate 182 days, because it could happen that whether you will include both the arrival and departure days. Consistently tribunals have held that you have to exclude the arrival date and only take the departure date while doing the consideration. There have been cases where there is a forced stay. In one of the Delhi High Court's decision, they held that there is a forced stay because the passport was impounded and the person could not travel outside India, though he had a valid ticket to travel outside India. The High Court held that because this is a forced stay, you did not calculate the number of days which is a forced stay while calculating the number of days for the residency. This becomes relevant in the context of COVID, because people who have had a forced stay in India, say because of lockdown, because of restrictions in terms of traveling outside India, or maybe restrictions in the other country where you could not have gone. The board in its circular gave very partial relief. The first circular for the first lockdown, they said when the lockdown was March 22 to 2020 to 31st March. So those 9 days they said should be excluded for calculating the number of days for residency. But when it came to the second year, that is the financial year 2021, assessment year 21-22, the CBDT in its circular 22 of 21 clearly clarified that we are not going to give you any benefit, even if it is a forced stay in India because of whatever reasons it might be, that cannot be excluded while calculating the number of days of residency for the purpose of Indian law. They made a statement that you can file a form NR with us and we will look into the respective case on a separate basis. However, we have not practically seen any action on that. So effectively, the assessees who, for at least for 21-22, for which assessments are going on, in those cases where the assessees are being forced stay in India, they have become resident in India, they could also trigger permanent establishment in certain cases, or they are on own to demonstrate based on the principle laid down by Delhi High Court that forced stays number of days should be excluded for calculating the residency test. They will have to demonstrate that why in each case their stay in India because of XYZ reason should be excluded for calculating say 182 day test or 60 day test plus 365 days test. So that becomes a point of a factual analysis in respective cases. There are other countries which have given that benefit, but Indian government, Indian board thought it fit that this benefit should not be extended. On a case-to-case basis, they will look at it. This was the Suresh Nanda's case of Delhi High Court. That could be relevant. And two circulars which I am talking, Circular 11 of 2020 and Circular 2 of 21. The Circular 11 of 2020 gave the benefit of 9 days, which could be excluded for calculating the residency. But the second circular said for the 21-22, we don't give the benefit. Now, when it comes to the basic test, we call this as a basic test. 182 days and 60 plus 365 days in 4 years as a basic test. The complication comes when we look at the exception to this basic test, and that is what has also been amended, especially the explanation B. Explanation A remains same. Explanation A remains same. Now, if we look at the explanation A and explanation B, these two explanations, what it does is the 60-day test in the 6.1 get enlarged to 182 days. That was the general principle, right? That 60-day test gets enlarged to 182 days if certain conditions are satisfied. If certain conditions are satisfied. And if those conditions are satisfied, then the second test here, which is 60 days plus 365 days, should be read as 182 days plus 365 days. Now, the amendment which has been made, we'll go to when we go to the explanation B, that curtails this 182 days to 120 days. So that can add to complexities, especially people who are Indian citizens and who are working outside India. For them, the period that they can visit India gets reduced because of the amendment. Now, what does explanation A provides first? So, explanation A says, person being a citizen of India. So, he should be a citizen of India. So, if person is not a citizen of India, this condition is not applicable. Who leaves India in any previous year as a member of a crew of Indian ship of so and so act, or for the purpose of employment outside India. Look at this word, for the purpose of employment outside India. The provisions of subclause C shall be in relation to that year, only in relation to that year, as if words of 60 days get substituted by 182 days. So as I mentioned, if you satisfy the condition of clause A, if you satisfy the condition of clause A, explanation A rather, then the 60 day becomes 182 days. Now what are these circumstances? 1, you are a citizen of India, condition 1. The person leaves India. So that means he is in India and he leaves India. He is in India and he leaves India. Then he leaves as a member of crew of Indian ship, or he leaves for the purpose of employment. So if these conditions are satisfied in the year in which he leaves, so this clause A is applicable only in the year in which he leaves, not in the subsequent years. In the subsequent year, what will be applicable is clause B, because clause B talks of a person being outside India visits India. So clause B, person who is already in India, say an Indian citizen who is say employed in US or UAE or Dubai, etc. When the year which he is living, you need to see clause A. In the subsequent years, when he comes to visit to India, you need to see clause B. Okay. Now clause A will say that you leave for the purpose of employment. For the purpose of employment. What do you mean for the purpose of employment? There could be various circumstances where say one leaves for self-employment. Can you cover saying that it is covered in this? When you leave, say for the company has subsidiary in India, the person is transferred from a US company having subsidiary in India. He is transferred from the subsidiary in India to subsidiary say in Singapore. Is he leaving for the purpose of employment, or is it just a deputation, secondment, and it is a temporary transfer, so it doesn't fall within the meaning of for the purpose of employment, for the purpose of employment. There are judicial decisions which have interpreted this word. Bangalore Tribunal has held that when we look at the word for the purpose of employment, it need not necessarily be new employment. It could be there is not necessary that assessee should be unemployed and he gets employed. There is no necessity that it should be new employer-employee relationship, point number 1. Second, it could be transfer within group companies also. So, a US subsidiary, US company parent having subsidiary in India transfers the employee from Indian subsidiary to say Singapore subsidiary, then also 182-day test can be satisfied. So, one can plan his affairs in such a way that his stay in India is less than 182 days, to ensure that in the year where it gets transferred, he becomes non-resident in India. To give an example, say there is a person who is getting transferred from Indian subsidiary to Singapore subsidiary. Suppose if the plan of transfer is 1st November, then his stay in India will exceed 182 days. If this is slightly tweaked say 1st October, then his stay in India will be less than 182 days. What this will do is, it will make him non-resident in India. And the Singapore salary which he gets say from 1st October to 31st March, which would have been otherwise taxable in India, doesn't become taxable because you are becoming non-resident in India. As I said, the scope of section 5 is, if you become non-resident, only income which is accruing or arising in India is taxable, and income which is accruing arising outside India is not taxable. So someone who becomes non-resident, by taking benefit of this clause, also same test will be applicable to him, and he can say that otherwise will lead to double taxation, because the salary given say in Singapore is also taxable in Singapore, and it also becomes taxable in India because you are having a dual resident, you are having a global taxation because you are resident and ordinary resident. No doubt, one will be able to take foreign tax credit for taxes paid in Singapore and against the taxes paid in India, because India being a country of resident and ordinary resident. But one situation itself can be avoided, because naturally there is a rate differential. Singapore would tax it at max rate of 17%, India would tax it at 30+%. So that additional tax outgo which could happen in India, if the associate wants to take the benefit of explanation A, he could say that I am travelling in a way that my stay in India is less than 182 days. But this test is applicable only in the year where you are going outside India for the purpose of employment. As I said, the purpose of employment could be not necessarily new employment, it could be continuing employment also. Another issue that arises, whether self-employment will get covered in this. The tribunal again helped in the golfer's case, that even if person is going for playing golf and if he maintains that 182 day outside India, he can take the benefit of this. So even a self-employment is covered in the words for the purpose of employment. There is a decision which has beautifully interpreted this, saying that for the purpose of employment means he should not have gone for the purpose of say private visit, medical, travel to something like that. Apart from that, everything, the word employment is wide enough to cover all of this. One can refer to Kerala High Court decision Abdul Razak 337 ITR 350, and where this aspect is discussed in detail. So one can look at explanation A in cases where assessee is going outside India. Second situation, now this person has already gone outside India, say taken employment in say Singapore or US or Dubai, wherever it is, and then he comes for a visit to India. Explanation B covers that visit to India. All along, this visit to India test also was easily accessible to the assessees, but the changes made recently makes it slightly difficult in certain cases. Now what the original provision said is, being a citizen India or person of Indian origin. Look at the difference. Whereas clause A applies only to citizen of India, clause B applies to citizen of India and person of Indian origin. So the scope of clause B naturally is wider than clause A. For definition of PIO, you go to 115C. Basically, ancestrals, either maternal grandparents or paternal grandparents being Indian born, then this person would qualify as a person of Indian origin. Comes to visit in India, comes to being outside India, the condition is being outside India, comes to visit to India, comes to visit to India, being outside India, comes to visit to India. And the provisions of subclause C, there the word 60 days gets substituted by 182 days. So, if I satisfy this test, I will take the first paragraph first and then come to second paragraph. The first paragraph will provide that if the person has gone who is outside India, he should be a citizen of India or person of Indian origin. And that person who is outside India, being outside India, comes to visit to India. So this is the important test that I have to satisfy. If being a citizen and person of Indian is factual analysis and based on the legal provisions as applicable, if he holds Indian citizenship and is a PIO, he qualifies that. The second is being outside India. What do you mean by being outside India? This is a very interesting case of Madras High Court. One should, if I have time, read that 199 Taxman 150, Appusara Ravi. Now in this case, the person was intercepted while carrying 10 kgs of gold at Chennai airport. Initially, the person made a statement that this gold is not mine. Some stranger gave me this gold at Singapore to be given to some stranger in Chennai. So this gold is not mine. When further this gold was confiscated and matters were discussed, matters were taken forward, the assessee claimed that he is non-resident by virtue of explanation B to section 6.1. The reason for which he is been staying in Singapore and he is on visit to India, so 60-day test satisfies becomes 182 days. His stay in India was 96 days. So if he was able to take benefit of explanation B, then he would become non-resident. But if he was not able to take benefit of explanation B, then he would become resident. And being a resident, his global income would naturally be taxable. Then his contentions that this gold is out of income outside India, this cannot be confiscated, all that would fall short. So the revenue said that the benefit of this explanation B is not applicable because he doesn't come to visit in India. Now how did they demonstrate this? On the facts, the Madras High Court held that this explanation's benefit is not applicable. After going through his passport entries and various other documentary records, the High Court records that when he first went out of India, he went on a 14-day visitor's visa, maybe a travel visa or visitor, they call it as visit pass outside India. And that pass he kept on extending in Singapore for a long period. And then also he traveled to Malaysia for 1 month, then came back to Singapore, then came back to India. So based on the entries in the passport, the High Court came to a conclusion that we are talking of a person being outside India. So first he should be outside India and then he should come to visit in India. But in this case, the person was not outside India, he was in India and then he took a visit pass and went outside India. So the benefit of explanation B on a factual analysis was not given to him and the benefit was not given. So for us to say that when I want to take the benefit of explanation B, the critical point is the person should be being outside India. Being outside India means a much longer period of being outside India, maybe in form of employment, maybe in form of other activities, vocation, business, etc. Such person who comes to visit to India. Now when you come to visit to India, that visit is not qualified in explanation B. If you say explanation A, when you go outside India, you should go for employment. But when you come to explanation B, they don't say it should be for so and so purpose. The visit could be anything. It is not qualified visit. It could be personal visit, it could be business visit or any other kind of visit. What is necessary? Say a person who is an Indian citizen who has gone out of India in year 1 and second year onwards when he is coming to visit to India, he should be able to say that I was outside India and coming to visit to India. So the test of 60 days becomes 182 days and therefore I should still qualify as a non-resident. So the income earned outside India in terms of employment income, etc., and maybe other passive income also will not become taxable in India, However, please note the amendment which is very critical in certain circumstances. So where it provides that in case of a citizen of India or person of Indian origin having total income other than foreign sources, so they use the word having total income other than income from foreign sources exceeding 15 lakh during the previous year, in his case the 60 days will get substituted by 120 days. So in a normal case, 60 days gets substituted by 182 days. In the cases which are falling in this amendment, then the 60 day gets substituted by 120 days. So naturally the leverage to come back to India for a visit reduces. Otherwise you could have stayed up to 180 days and still qualified as a non-resident. Now someone has to stay less than 120 days to qualify as a non-resident. Once he exceeds 120 days, if these conditions are satisfied, then he becomes a resident in India. He may be resident in that country also, then the dual residency under the treaty will trigger. And then we need to tie break and see where he will qualify as a resident. So otherwise, if these conditions, what are these conditions? So citizen of India, person of Indian origin, similar condition. The condition here is the total income other than foreign sources. So other than foreign sources, I will term it as Indian sources for our discussion. The total income from Indian sources should exceeding 15 lakh rupees So a person who has Indian source income more than 15 lakh rupees, in his case, the test of 182 days will not be applicable, the test of 120 days will be applicable. Once you fall in this category, you become a resident. Once you fall in this category, you become a resident. That means 120 to 180 days. This special situations. If you cross 180 today, you are anyway resident. There is nothing going to help you. 120 to 182 days crossing 15 lakh rupees, you are a resident. But whether classified as an ordinary resident or not ordinary resident, we will see as we go forward, right? But this is an additional category which gets created by the amendment which has been made in section 6.6. Before going to not ordinary resident, I will just highlight one part and come back to this. A new section 6.1a was inserted to bring in within its ambit taxation of stateless person. Now, why this was inserted? Please look at if we look at the memorandum, we get in clarity that why this particular clause was inserted. What it provided was the issue of stateless person has been bothering the tax world for quite some time. It is entirely possible for an individual to arrange his affairs in such a fashion that he is not liable to tax in any country or jurisdiction during the year. This arrangement is typically employed by high net worth individuals to avoid paying taxes in any country, jurisdiction on income they earn. Tax laws should not encourage a situation where a person is not liable to tax in any country. The current rules governing tax residence make it possible for high net worth individuals and other individuals who may be Indian citizens who are not liable to tax anywhere. So what they are trying to say is that there are high net worth individuals. So that is possibly they have put the 15 lakh total income cap. These high net worth individuals, it is possible for them that they are not resident in any country, which is naturally possible because if you say 182 test in India, you take a similar test say in Singapore, Thailand, etc. It is possible to arrange an affair that you are not resident in either in India, Singapore or Thailand. Because of the number of days test in respective countries, one could possibly split his physical stay in 3 countries in such a way that it would be possible. It may not be possible if the residency test is linked to citizenship like many countries in Europe, Spain, Portugal, Hungary, where the test is linked to citizenship, or US is the best example, where test is linked to the citizenship. So if you are a citizen of US, no matter whether you are staying in US or outside US, even if you're not staying a single day in US, you become taxable in US, right? So, but given that it was linked to physical stay, and in the current scenario where the kind of world we have, where it is possible to move for opportunities into different geographies, it is possible for one to be non-resident in all the countries. So the idea was, if there are high net worth individuals, these categories of high net worth individuals, we want to bring them within the tax net by creating a new category of residency. So the amendments which all were made in section 6.1a plus 6 were all in line of this particular objective. However, we will see that when we see the overall perspective, somewhere the entire objective has not been achieved, because it is still possible that these high net worth individuals, even after the amendment, are not taxable in India under certain circumstances. So what the amendments have been made? One, as I said, is the definition of explanation B gets amended. Then look at the definition of stateless person. So we call it as a stateless person. 6.1a says, notwithstanding anything contained in clause 1. So it overrides 6.1. An individual being a citizen of India, so it covers citizen of India, not PIO, having a total income other than foreign sources, as I said, total income from Indian sources exceeding 15 lakh rupees during the previous year shall be deemed to be resident in India in that previous year. So someone who is having Indian source income greater than 15 lakh rupees will be deemed to be resident in India. The condition is he is not liable to tax in any other country or territory by reason of his domicile, residence or any other criteria of similar nature. So the condition is, if you are not liable to tax in any other country by reason of domicile, residency or any other criteria of similar nature, and if your Indian income exceeds 15 lakh rupees and you are a citizen of India, in that circumstances you are deemed to be resident in India. This overrides 6.1, therefore you need not even stay for a single day In 6(1)(a), you need not stay for even a single day. The conditions are, you are citizen of India, you are an individual being a citizen of India, having total income from Indian sources greater than 15 lakh rupees in that previous year, and you are not liable to tax in any country by reason of residency, etc., etc., etc. So if these conditions are satisfied, even if your stay in India is 0, you are still deemed to be resident in India, right? You are still deemed to be resident in India. So this was the original enactment or original objective which was inserted, right? Now this naturally has a very wider gamut. Once you are citizen of India and you are not paying taxes anywhere, then you deem to be resident in India. Now, if this category was treated as ordinary resident for any reason, then his global income would have been taxable, even if his stay in India was 0 days, right? They made certain changes subsequently because there was a lot of hue and cry raised about the provisions. So naturally they made, based on the feedback they would have got, they made certain changes. And based on the overall perspective, changes made to 6(1), 6(6), and 6(1)(a), we will try and analyze what is the overall impact of this amendment. First, let's understand 6(1)(a) in more detail. So this is what the objective is there. Now, if you'll see how 6(1)(a) proceeds, it says that there should be income other than foreign sources which crosses 15 lakh rupees, right? And you are a citizen of India. The first is you should be a citizen of India. As I said, all along we have always been talking of a physical stay. We make a deviation in this particular provision where the residency is based on citizenship, 1. Second, the quantity of number of days of stay gets replaced by quantity of total income. We have been taking off all along that you should be physically present in India for so and number of days. That gets replaced by quantity of total income, and that total income is 15 lakh rupees. Erstwhile, to compute total income, you have to determine residency. Now, to determine residency, you have to compute total income, right? So earlier, we always determine total income next. First, we determine residency, and based on residency and scope of total income, you determine total income. Now you have to first determine the Indian source income and then determine the residency. So they have changed the way the residency provision would work if these conditions are satisfied. Now they say that you should look at income, total income other than foreign source income. Now what they have defined the foreign source income, they have defined the foreign source income as income which accrues or arises outside India except income derived from business controlled in or a profession set up in India and which is not deemed to accrue or arise in India. So you take the incomes, all incomes what the assessee has, and from all those incomes, you see what is income which is deemed to accrue or arise outside India. Or put it other way, you need to see what is the income which is deemed to accrue or arise in accruing in India, deemed to accrue or arise in India, or income from business controlled in India or profession set up in India. So these category of income should be excluded from the all incomes which the assessee has. So what we need to see is what is his list of incomes. Out of these lists of income, what incomes fall, say, in section 4 of the Indian Act, section 9 of the section 4 and 5 of the Indian Act, section 9 of the Indian Act, and what incomes are from business controlled in India and professions set up in India. The difference between language in 1A vis-a-vis 5(2) proviso is, there it was business controlled from India, here it is business controlled in India. So anyway, that difference is there. Both have slightly different meaning, but without going into complications, basic thing for us to understand is, if it is business controlled in India or profession set up in India, it is Indian source income. If it will be an Indian source income. So if a person has business, say, in Dubai, he is controlling that from India, that will be treated as Indian source income, and that will be taxable, that will be computed for calculating the 15 lakh limit. Now, once we do that and see that the income exceeds 15 lakh rupees, Indian source income exceeds 15 lakh rupees, then the next thing we need to see is whether he is liable to tax in the other country. Naturally, one starts giving the example of countries where there is no personal taxation. Say, for example, UAE, where there is no personal taxation, or there could be a lot of such countries where there is no income tax on the individuals. What income they earn, there is no taxes. Can you say such people who are not liable to tax, who are not actually paying taxes in those respective geographies or jurisdictions, can they say that they are not liable to tax? Because the words used are that you should not be liable to tax in any other country by virtue of domicile, residency, etc. So this was the, when the initially 6(1)(a) was proposed in the bill, this was an objection raised against the provision saying that if this condition remains as it is, every person who is having income in Dubai, he is having employment income there, he is not liable to tax in Dubai because there is no personal income tax there. His income become taxable in India. The board clarified by press release that that is not the intention of this particular provision, and it only we will tax those incomes which are in India or controlled from business or profession in India. We will see that in 6.6. But the point here is, what do you mean by liable to tax, and whether actual payment of tax means liable to tax or difference between liable to tax and subject to tax. This was an interesting decision of Supreme Court in Azadi Bachao Andolan 263 ATR 706. What is the difference between a person being liable to tax and subject to tax? They said subject to tax means person actually pays taxes. Liable to tax means he is liable, but the statute may not collect any taxes from him. So if the statute, under the local laws, if a person is covered within the dominion of that provision, say that he is liable to tax. So for example, agricultural income in India, a person is liable to tax, but because of exemption, he is not taxable. So he is actually not paying taxes. So the decisions of various courts consistently, Azadi Bachao Andolan, G, Pension Trust, what they say is, what is necessary is that it is not necessary that he actually remits taxes. It is sufficient that he is liable to taxes and that state has powers to levy taxes. Whether that state levies taxes or does not levy taxes is irrelevant consideration. So this made this provision, it mellowed down a provision a bit, otherwise the impact of this provision would have been very vast. So what effectively it means is, if my presence in that country is such that I qualify as residence there and that country has a right to tax me, it may actually not tax me, that's a different issue, that would be sufficient to qualify as liable to tax. However, it would still not cover cases where you are non-resident in all the countries. As I said, if person could plan his affairs where he is non-resident, say in India, Singapore, Thailand, splitting his days in all the 3 countries, it is possible still, and those may not, we cannot say that they will still fall within the ambit of liable to, not liable to tax. Okay. Now, let's go back to the definition of 6.6 and not ordinary resident. One very interesting point which will come up is, once you become resident under 6.1(a), what will be your scope of total income? What is that you are really liable to pay taxes in India? Will it be global income that is liable to tax in India, or is there any restriction which will be there? So, suppose a person now becomes resident by virtue of explanation B, new extended definition, 120-day test, 120 to 180-day test, he falls in that category and becomes resident. Or a person becomes resident because of 6.1(a). He may not be in India for a single day, but he is stateless person, he is not resident anywhere, and he becomes resident in India. So if you become resident in these 2 categories, what would be the scope of total income for such person? That is now by virtue of amendment which has happened to 6.6(a). As we all know, 6.6 provides for condition for being not ordinary resident, or what circumstances one would be resident. In what conditions one would be ordinary resident, and what circumstances one would be not ordinary resident. This is provided in 6.6. This also underwent a change many years back. Originally, all of us said if to become an ordinary resident, one has to be in India for 9 out of 10 years. That was reversed exactly to say that now an individual be resident but not ordinary resident if he satisfies the following 2 conditions. Either of the following 2 conditions, any one of the conditions. One says you should be non-resident in India 9 out of 10 years. So in the preceding 10 years, out of that, if you become non-resident in India for 9 out of 10 years, you become not ordinary resident. If you become resident just for 2 years, you become ordinary resident, right? And in cases where the second situation, in the 7 years, the stay in India is less than 729 days. So these are the old standard tests. What have they done is, apart from these two situations, they have prescribed 2 new situations, and in these 2 new situations, the person will be treated as not ordinary resident. Person will be treated as not ordinary residents. So these clauses C, 66C and 66D have been added to the definition of not ordinary resident, wherein it has been provided that a citizen of India, or a person of Indian origin, who becomes resident by virtue of explanation B, explanation 6.1, explanation 1B, because of that, if he becomes resident, in his case, he will be treated as not ordinary resident. So anyone falling within 120 days to 180 days, anyone falling within 120 to 180 days, as I said, explanation B now is 120 in certain circumstances, that person will be treated as not ordinary resident. Then any citizen of India falling in 6.1A, 6.1 capital A, that person will be treated as not ordinary residents. So in these two categories have been effectively made as not ordinary resident. Now let's look at the entire thing once again. So these people who, the objective of, what was the objective of amendment? The objective of amendment was that there are people who are taking the benefit of this 182-day test. To that extent, it gets satisfied because now we are able to bring down the test to 120 days, in certain cases even 0, right? That is still taken care. But whether that person who would earlier be non-resident, whether he becomes ordinary resident, no, that person moves from being a non-resident to resident but not ordinary resident. Now the difference between this system of taxation will only be that earlier he was taxable only on income which accrues arise in India or deemed to accrue arise in India, but by virtue of amendments, additional layer of taxation of stream of income will happen, that is for business controlled in India or profession set up in India. So these are 2 additional legs of streams of income which become taxable in India by virtue of the amendments which are made in India. Now to demonstrate that the business is controlled from India or profession is set up in India, that will be something which is not always easy. No doubt there will be email trails, etc., where someone can dig and find out that business, whether it is controlled in India or profession is set up in India. But that is only the additional stream of income that gets taxable. However, by amendments do not bring within their ambit a lot of other passive incomes like capital gains, dividends, etc., which may go still tax-free. So if you look at the entire amendments which have been made, the net effect of that, what was the original objective, that we want to tax high net worth individuals who have become tax nomads, who are not resident in any other country, and bring them to Indian tax. The amendments do not really give effect to the objective which was there. But for us to say that, understand that there is a new category which is 120 to 180 days, 6.1 capital A, and those will be resident categories, but the scope gets slightly enlarged, but not to that extent what gets enlarged for a resident and ordinary resident. Considering this, we will now move to residential status under the treaties. So as we see, and dual residency, how we look into the cases of dual residency, dual taxation in these cases. So there is situations where a person may be resident in this country and a person may also be resident in some other country because of various reasons. One, we may follow a different year, that country may follow different year, that country has a lower threshold for being resident, that country may treat the person as a resident on citizenship. So these all could trigger taxation, double residences, and that is where 4.1 will come into picture. What 4.1 provides is that it doesn't give new tests to determine what is residency. It doesn't give new tests. The test to determine residency is always based on the domestic laws, whether domestic law of India or Singapore or Thailand or Australia, whatever it could be. The test to determine residency is always based on the domestic laws. What 4.2 does is, 4.1 and 4.2 does is, it provides a way out if you are resident in 2 countries. So 4.2 gives a sequential test to say that if you're resident in two countries, how do you determine, which we call as a tiebreaker rule, how do you break the tie in favor of one country and say that you are resident of one country and non-resident of other country? What effectively that will do is, a country where he is resident will get a taxing rights to tax his global income, and the country where he is non-resident will not have those rights. Plus, the country which taxes the global income will also give the credit for foreign tax credit. Foreign tax credit, as we all know, in India we'll have to file Form 67, and if your global income becomes taxable, then you'll have to claim that foreign tax credit in India. There has been good amount of litigation in India, but now at least the delay in filing Form 67 all has been taken care based on the Bangalore Tribunal decision, Brinda Ram Krishna. Then the law has been amended where you can file Form 67 later. This arises because the tax return in that country might have been filed late, there could be difference in calendar years, all that. But one good thing is, now you have an additional time to file Form 67 up to 31st March of the assessment year, within which period this Form 67 can be filed and the credit for foreign taxes can be taken. Then, what would be the circumstances where, how do you determine, how do you apply the tiebreaker rule? The tiebreaker rule basically has a sequential test. The sequential tests are permanent home, habitual abode, economic and social interest, what we call as vital interest, and then the nationality test. We'll discuss some interesting decisions, very situations where we may see these kind of cases on a regular basis. One Australian case, one Indian case, and one UK case. How different countries are applying these tests to understand what are the ramifications of this test. This case is of a Pike versus Commissioner, PIKE. It's a recent case where the Australian court had to decide for a person who was born in Rhodesia, southern Rhodesia, which got independent and became Zimbabwe. The person was born there, and in 1980 somewhere, 70 somewhere, his wife was working in accounting firm Ernst & Young, and this person was, the assessee was, an expert in tobacco field. He was an expert in tobacco field. But the recession hit them, and the situation in the country was not good. They thought it to migrate to some other country. The wife was able to get job in EY Australia, Brisbane, and they decided to migrate to Australia in 2005. So they moved to Australia in 2005. So they had permanent home in Zimbabwe. Their family, mother, father, brothers, everyone stayed in Zimbabwe. But these two families with their two sons migrated to Australia in 2005. The wife joined the accounting firm EY, whereas the husband, Pike, who is the assessee, did not get any job in Australia because Australia had at that point of time banned all tobacco growing in that country. So he could not get any job in Australia. He found a job in Thailand, and he joined in for employment in Thailand from 2005 onwards. Because he could not get anything in Australia, he joined a job in Thailand. Wife and children stayed back in Australia, and they had that particular employment visa which continued. Wife and children got the citizenship in Australia in 2010. The assessee got citizenship much later in 2014. The issue was, when he was working in Thailand, he had a rented apartment in Thailand. They also had a rented apartment in Australia. How do you, and then there were certain other events, and it's a very good decision if one reads this decision when we be able to see how facts are captured. He kept on, and the wife suffered an injury and had to give up the job. She was not earning financially. The husband from Thailand kept on transferring financial aid to the financial funds to the wife and children. The education of children was continued in Australia. He also financially helped his family members, mother, brother, and two brothers in Zimbabwe through transferring the funds. In between, he had a promotion. He went to Tanzania, then to Dubai, and then back to Australia somewhere in 2014. Tax officers being tax officers, they made an assessment from 2010 to 2014 of his Thailand income, contending that he was resident in Australia because he had a permanent home in Australia in terms of rented apartment of wife, and both was joint name, and therefore even that income is taxable in India. So naturally during this period he visited Australia on a regular basis. So in a year he might have visited 100 days, some years 120 days, some years 90 days. So the decision gives out the complete list of what number of days he has visited. Every year he must have visited 25-30% of time to Australia. The tax department taxed his entire income from in 2010 to 2014 as taxable in Australia on the ground that he was resident in Australia, and the Thailand salary is also taxable in Australia. The rate of taxes in Australia are much higher compared to rate of taxes in Thailand. First, they did not give the foreign tax credit for taxes paid in Thailand. Later on, they amended the order saying that we will give you the foreign tax credit. But despite giving foreign tax credit, Australia having one of the highest rates of taxes, there was a substantial tax that the assessee had to pay, right? The assessee challenged this, saying that he should not be taken as resident in Australia. Now, the court analyzed the decisions in a very detailed manner and applying the tests of 4.2 of the Australia-Thailand tax treaty, saying that whether he will be a tiebreaker rule has to be applied and whether he will be classified as resident or in Australia or not in or in Thailand. Now, they concluded that he was also resident in Australia because of the domestic laws of Australia. Then naturally I have to apply the tiebreaker rule and then break the tie, saying that where he will be resident. Considering that the first condition was whether there is a permanent home. Now, he had a rented premises in Thailand and he had joined various associations, clubs, etc. He also had a social life in Thailand, friends, etc. in Thailand. Because he was working there, naturally he developed that social relationships also in Thailand. So he had a rented premises both in Thailand and in Australia. The question was whether this will constitute the permanent home, which is the first test. The court came to a conclusion that this will not constitute a permanent home. The reasons given by the court were, looking at the circumstances, he had to change this rented premises many times. They give those dates, etc., saying that he does not qualify as a permanent home. Permanent means it should be permanent for a certain period of time. So the test of permanent home will not be satisfied. When we contrast this with an Indian decision, they have said rented home is a permanent home. And whereas this decision took a view that rented home is not a permanent home. Ideally, rented home, which is available for a good amount of time, should be classified as a permanent home. And the assessee everywhere, wherever he had given his applications for whatever documents or government regulations, he always gave the permanent home address as the Australian address. This was assessee's own declarations, right? We also fill up a lot of forms saying what is a permanent home. And this assessee himself had given the Australian home as a permanent home. Okay? And even for visa application, citizenship application, the assessee had given the Australian home as a permanent home. Despite that, the court appreciated the fact that permanent home for visa purposes and permanent home for tax purposes could be different. And they said assessee had the permanent home both in Thailand, because he had a rented premises there also, and he had access to that. So therefore, if you see the test as permanent home, they do not qualify as a permanent home. And if you take the rented premises as permanent home, he has rented premises at both the places. So therefore, this test does not decide whether he's a resident in India, or resident in Australia, or resident in Thailand. The next situation was, where are his personal and economic relationships closer? Where are his personal and economic relationships closer? Now look at this. His personal relationships are in Australia because his family and children are in Australia. The children are studying in Australia. But his economic relationships are in Thailand because this is the place where he earns the income, and that income financially supports the entire family. Extending the personal relationships, the court also went into the fact that he has his friends, clubs, etc. in Thailand also. It is not just restricted to the family which is there in Australia. And economic relationships are entirely in Thailand. The court also went into the fact that his family stays in Zimbabwe. Other extended family in terms of parents, brothers, sisters, etc. all stay in Zimbabwe. That is also a relevant factor and not just the immediate family. Considering all these facts, the court came to a conclusion that the person is non-resident in Australia. the main ground for them to come to a conclusion that the economic relationships are entirely in Thailand because there is no earning activity, not a single amount of earning activity, investment activity has happened in Australia. Everything is in Thailand, so entire economic relationship is in Thailand. Therefore, he qualifies as a resident of Thailand. In the order passed by the commissioner, taxing his entire salary income in Australia was held to be not taxable. So this is a very good way in which the factual have been analyzed and a conclusion has been drawn in terms of a tiebreaker rule. We have a similar very interesting Indian case. The person was resident in India. In December 14, he moves to Singapore. He gets 47 lakhs income in India and the balance income of 1 crore odd in Singapore for the balance 3 or 4 months period, whatever 4 months period, 1st December onwards to the Singapore. Originally, SSC filed a return of income because he was more than 182 days. Now his test is, so if you are living outside India also, as we have said, he has to leave India for the purpose of employment. The test becomes 182 days, but in this case, he even crosses that 182 days. Therefore, he was a resident in India. Because he was a resident in India, originally he filed a return of income offering to tax the Singapore salary and Indian salary both together. The SSC filed a revised return, maybe on advice of some tax advisor, saying that the Singapore income is not taxable because applying the tiebreaker rule under the India-Singapore Treaty, I am a non-resident. Right? He had gone to Singapore with his family and 2 daughters. The 2 daughters joined the education there, and he had a home, permanent home in India, which was let out. So SSC's argument was, this home is let out, I do not anymore have an access to this house, whereas my rented home in Singapore, I am using it for my purpose of stay. So that is where my permanent home is, right? The assessing officer rejected these arguments and said that entire income, the Singapore income also becomes taxable in India. And therefore, both Indian income and Singapore income, total 1.59 crores, has originally offered in the original return becomes taxable, and revised return curtailment of income was rejected. Naturally, appeal was filed, CIT upheld the order. The matter traveled to the tribunal. Tribunal observes that he has a Singapore driving license, Singapore bank account. He has a tax residency certificate issued by Singapore authorities, and TRC is issued by Singapore authorities. That TRC is accepted by revenue, Indian revenue. They did not say that it is bad or it is not correct or something. They did not say that. On his official forms, he gave both India and Singapore as his country of residence. Look at the first case, where he gave only the Australian home as his permanent home, whereas in this case, the SSC gave both Indian and Singapore home as his home. In the first case, also one more factor which I missed is the electoral rolls of this person in Pike's case got updated only in 2014 because he got a right to vote only in 2014. Till then, he did not get right to vote. That also was a deciding factor in Pike's case. No doubt in this case, that aspect doesn't come in. But in this case, the SSC gave both the addresses of Indian home as well as Singapore home in all his official communications. He paid taxes in Singapore while working there, and he also, in the future years also, whenever he has had Singapore income, he paid taxes there. Naturally, after some years, he came back and then he had continued in India. The ITIT said that a house in India which is let out does not qualify as a permanent home because SSC does not have an access to that permanent home. House in Singapore, which is also a rented premises, will qualify as a permanent home. His center of vital interest, what we call the personal and economic interest, are in Singapore because he shifted to Singapore with wife and daughters. He shifted the employment because the entire employment income now is in Singapore, nothing is earned in India. He earned and saved in Singapore. Based on this fact, the tribunal concluded that center of vital interest of this person is in Singapore, of the SSC in Singapore. Samir Malhotra is in Singapore, and therefore he will qualify as tax resident of Singapore. And what is taxable in India is only the Indian portion of salary for that 8 or 9 months. The deciding factor possibly in this case where the family moving with the SSC, entire income of employment coming from Singapore, nothing being generated in India, vis-a-vis if you had a substantial income in India, for example, rental income, interest income, etc. in India, passive incomes in India, that would have possibly tilted the scale the other way around. Family not moving would have tilted the scale the other way around. Given that entire family moved with him, that helped him to demonstrate that his personal and economic interest lies in Singapore. Applying the tiebreaker rule, this person was classified as a resident of Singapore and held that he is non-resident of India. Last case we will deal with the most interesting case, Jonathan Oppenheimer. He was born in Johannesburg, South Africa, was a citizen of South Africa. His parents were expert in diamond business, so they moved to UK, a diamond trading company which was a subsidiary of DPS. But being in UK, he spent all his holiday in South Africa. For his 18th birthday, his family brought him a house in London, but that house was held in a trust. In 94, the assessee marries an US nationals, and he completed his internship at DBS and started working in London. In 95, assessee relocated to Zimbabwe for a few years and then moved to South Africa. And this assessee has worked everywhere, effectively working in various places like Luxembourg, Ireland, and other countries. So this is where his career is spanned over many geographies. Then in 2007, he moves to UK and purchases a resident family farm in UK in 2007. In 2010, he files the return for first time in UK, saying that I have come till 2010-11. He files his return in 2010-11. Before that, the argument was he was simply visiting London or UK, and he was not a resident of London. UK has a similar test of visit like we have, and therefore the visit provisions might have been applicable there. And he said, I am only visiting earlier, I was not a resident earlier, and now only from 2010 onwards, I become resident. I am filing return of India. He may not still have qualified as resident there. The tax authorities make an assessment from 2010-11 to 2016-17, taxing GBP 20 million that he received from various trusts as his income in UK. So he was beneficiary of various trusts. A lot of these trusts had assets in South Africa and a lot of tax havens. Those trusts made declarations to his beneficiary. He was the only beneficiary, so he got a lot of distribution from those trusts. Now, assessee did not offer those incomes in UK, which quantified to 20 million GBP, 20 million pound. He did not offer to tax in UK on the ground that he is not qualified as resident under the tax treaty. From 2010, because he took a house there, he was staying there, he accepted that he is resident in UK. But under the treaty, the contention was he is a non-resident, and therefore his only UK income should be taxed in UK. The global distribution which is happening from various private trusts in which he is a beneficiary, which are totaling 20 million pound, should not be taxable in UK. So these were the facts in this particular case. The government, the revenue, naturally held that even under Article 4 of UK South Africa Tax Treaty, vis-a-vis UK local law, he is resident in UK and the entire income is taxable in UK. Under the domestic law of UK, there was no objection by the assessee. He accepted that he is resident in UK. So now he becomes resident in UK as well in South Africa. So applying the tiebreaker rule, one needs to decide whether where did he get, where is he taxable. Now this person had permanent home both in UK because he took a farm in UK, and his ancestral home and other properties were always in South Africa. So therefore he had a permanent home in both the countries. The main case came up whether he has the center of vital interest in South Africa or center of vital interest in UK. And given that he was spread across so many countries, his assets and incomes were spread across so many countries, that becomes an interesting point. So the tribunal held the burden of proof is on taxpayer to prove either where is his center of vital interest. Now what are the facts? They said majority of friends and family of taxpayer reside in South Africa. Majority of friend and family reside in South Africa. Extensive family wealth is based in South Africa, though held through multiple trust structure. So extensive family wealth is based in South Africa. The taxpayer casted his vote in South Africa, never voted in UK. So that is another factor which the court took into consideration. All his philanthropic work, charity work was in South Africa. His doctor, his dentist, his cricket team, his political interest, all were based on South Africa. Look at this, how small things add up here. Just being a fan of a cricket club adds up. Being a dentist, going to a regular dentist adds up. So all these facts, they said, demonstrate that he is a person of South Africa. The court said his schooling in UK is not relevant. Because when he was doing a schooling there, it was a temporary, it was a transient thing. Just doing schooling in UK will not determine in resident, because that is not a relevant factor, and they rejected that thing. Because after doing schooling, he moved out of UK and did a job in different countries. Considering these facts, the court concluded that the center of vital interest of this assessee is in South Africa, and the 20 million pound which the UK government taxed it was not taxable in India. Possibly he would not have paid the taxes in South Africa also, I am not aware of that. But because it is held to multiple trust structures, we don't know where it really got taxed. But the facts, the point is, look at the facts, how small things, even in terms of those add up to determine how the residency test can be applied and how it can get complicated in various situations. The court observed the taxpayer's lifestyle is more complex. He has lived and worked not only South Africa, US, UK, but he has worked in countries like Luxembourg, Ireland, and other countries. So he's worked in so many countries, you cannot really pinpoint one particular matter. He has spent greater time in UK because of schooling, but that is not relevant. His wife and because of his wife and child, but he could and did return to South Africa for important meetings. All his families, business, philanthropic work, political, social activities, all are in South Africa, and he working in multiple countries is an important regular part of his life throughout the relevant period. So he being part of various countries is an important part of his life. But what conclusion on social and economic interest? Economic interest, if you look at this case, he had extensive wealth in South Africa. He had all his activities, family, extended family, philanthropic work, other social ties in South Africa. That possibly tilted the decision of the court to say that he is a resident of South Africa and he is not taxable in the UK on his other incomes of other than UK income. Therefore, the court concluded that it is not taxable in UK and it is taxable in South Africa. So these, I thought, are some interesting decisions of different countries which bring to bring out a point that how complex it could be in certain cases, how interesting it could be in certain cases. The main point that is how factually we bring out the importance of small things and how these all can add up to determine how where is the center of vital interest in terms of social and economic ties. Because that is becomes a critical point whenever we are determining the dual residency, how you demonstrate this particular aspect and come out with a situation where is he really resident. Then we will just cover up and tiebreaker rule in most of these cases is very similar to what we have under the Indian treaties with most of these countries. There is a standard pattern of language used. So these decisions, though being in global context, will also be relevant under the Indian law also. Then we come to Article 16, and where we see today work from anywhere, work from home, and how Article 16's interplay with this and Section 912's interplay with this helps us to determine the taxability in these kind of a situation. See, Section 912, as we all know, the taxability of salary income is where you have exercised the employment. That means where are you physically present to do the job. So you may be getting salary from, say, German company, but you are physically present in India. So the employment is exercised in India. Take the converse of this also. Indian company paying salary, they have sent a person for 12 months, say, to US or UK, etc., and Indian company paying a salary to that person. And if he is a non-resident, then in those cases, the employment also being exercised outside India, it doesn't become taxable in India, and even under 912 also. So the place where
the assessee is physically present is what is relevant test in the both under the Act and treaty. No doubt, in today's world, that has become problematic because physical presence and actually doing work are no more connected in many industries. You may be physical present in any part of the world and may still be doing the work. That's why we have a concept of work from anywhere, right? So in those cases, how this, given that the law today does not visualize any amendment to the physical presence test, those cases still the physical presence itself is important. And that itself is still the drawing point unless the law is changed on that particular point. Because we are seeing and we will see cases where person is working for one country, but he is physically present in another country. They may be spending their lot of time, say few months outside India. They might have just, because it's work from anywhere, just go to any other place, any other country, also fulfill your dream of seeing the world and at the same time work from that. No doubt we CAs don't have that benefit or that doesn't gel with us, but a lot of IT industry people are able to do that. Now, section 912, physical presence become important. Similarly, in section 16, article 16, or it could be 15 in some treaties, the test is based on where is the employment exercised, country of residence. First is the country of residence. So if country of residence gets the primary right to tax it, so if a person is employed in India, India gets a primary right to tax it. So that is the first situation or first point we have to keep it in mind. The country of source, that is where the employment is exercised. So a person of Indian resident or resident in India, say goes for 3 months to Singapore, right? Now, whether Singapore would get a right to tax that income of 3 months is the moot question that we need to answer. Because in cases where people are using the philosophy of work from anywhere, for 2 months they may go to Mauritius, 2 months they may go to Maldives, and 2 months they may be somewhere else. But they may still be resident in India, the salary may be paid by company in India. Whether in that circumstances, those countries where he has spent say 45 days on a holiday with work from anywhere, whether those countries get a right to tax that income. Section 16 says country of residence gets a primary right to tax it unless the employment is exercised in another country. Now, employment being exercised in other country, what do you mean by employment being exercised in other country? All the commentaries' decision says where the person is physically present, that becomes a place where the employment is exercised. That becomes a place where the employment is exercised. Taking this forward, however, this main condition is subject to short stay exemption in Article 16(2), right? Short stay exemption in Article 2. So primary condition, taxable in country of residence. So in my example where I have given, he has been say 200 days, 240 days in India, 40 days in say Maldives, 40 days in Mauritius, balance days in Singapore. So whether those countries can tax it. So India being country of residence can naturally tax it, right? But whether those countries can tax it. Now section 16, article 16(1) does say that if the employment is exercised in those countries, it can tax it. But that is subject to article 16(2). What does 16(2) says? It gives a short stay exemption, we call it short stay exemption. Notwithstanding anything in paragraph 1, so it overrides paragraph 1, remuneration derived by a resident of a contracting state, resident of India say, in respect of employment exercised in say in Singapore, is taxable only in the first mentioned state. That means it is taxable only in India if 3 conditions are satisfied. The stay in other countries is less than 183 days in 12-month period. It could be 12-month fiscal year, but mostly it is a 12-month condition which is there in most of the treaties. The salary should not be paid by a resident of Singapore. The salary should not be paid or borne by a permanent establishment in Singapore. So these are 3 conditions. So if we take our example, an Indian resident who has from his company work from any their option, he goes to 60 days in Singapore, 60 days in Mauritius, and balance days is in India. Can Singapore tax his salary? Employment is exercised in Singapore. So one condition is satisfied. But that condition is subject to exception. The exception is he stay less than 183 days? Yes, his stay is less than 183 days. He is eligible to take short stay exemption. Second condition, the salary should not be paid by a resident of Singapore. Salary is paid by Indian company. So it is not taxable in Singapore. Salary should not be borne by a permanent establishment in Singapore. There is no permanent establishment in Singapore because the company is in India. So going by the current law, though he may be exercising the employment in those countries, the country of residence, that is India in our example, will get a right to tax it. and he can claim a short stay exemption in those countries, and the income will not be taxable in India. Just to repeat and summarize, the primary rule on 912 is the place where the employment is exercised. Even the leave day succeeding or preceding the employment are counted for where the employment is exercised. That clause was basically inserted for people who are on marine ships, because they generally have a policy of 20-day present and 20-day on, 28-day on, 28-day off. So 1 month they are on ship and 1 month they may be in the territory India. So the question was, when they are getting salary, say for first 28 days, they may be outside Indian territorial water, they may not be taxable in India, right? Because they are outside the Indian territorial water. The next 28 days, they may be in India, and they may be getting salary when they are physically present in India. The question was whether this balance period becomes taxable in India. The law today says is the leave period succeeding and preceding the job period, that is the on period and off period, will be counted as employment exercised in India. So that also doesn't become taxable in India. So this is how the law in 912 say. This article under the treaty follows a similar principle. First principle, taxable in country of residence unless employment is exercised in other country. But if the employment is exercised in other country, you have a benefit of short stay exemption. 183 days should not be paid by a resident of that country, should not be paid by a permanent establishment in that country. If these three cumulative conditions are satisfied, only the country of residence will get a right to tax it. Only the country of residence will get a way to tax it. So this also, as I said, in the new situations, could become an interesting cases, especially post the COVID. We could have similar cases as we have seen some cases in tiebreaker. This kind of cases also we will see where these kind of complex facts could be there, like in Jonathan's case, which has its own interesting decisions, which we could see in future. Secondment and deputation, we have another 10 minutes. We'll try and quickly look at 2-3 more. This one last issue. The movement abroad. So this is basically when the group companies are transferring within the group companies. So between, say, Indian subsidiary and holding company outside India, or the other way around, holding company outside India and Indian subsidiary, or Indian holding company and other way around. So where the movement is happening, there the linkage with the employment of parent company and linkage with Indian company generally continues, because we also have social security arrangements with most of the many countries where you may continue to have the benefit of social security in respective countries. So if I take, say, for example, Japan, people from employees of Japan X company limited will be moving to Indian company. The part of salary will be paid in Japan and part of salary may be paid in India. The salary is continued to be paid in Japan for the reason of various reasons. It could majorly is a social security reason, promotion, retirement benefits, for all those purposes. Or there could be always an objective of going back to the parent company or parent country, which is Japan in our example. Because he may come here for, say, 2 years period and then want to go out back to Japan. So in these cases, one of the issues which arises here, there becomes a dual employment. Now dual employment also raises a issue which the revenue has always considered as this payment, which, so the salary says 100 rupees, 50 rupees paid in Japan, 50 paid in India. Then Indian company may reimburse 50 back to Japan. So this reimbursement of 50 rupees which is being paid to Japan, whether it becomes a fees for technical service for the Indian company, and Indian company is liable to the TDS. Added issue is the Northern Operating decision in the context of service tax, which they said then when this reimbursement of salary is paid, service tax has to be discharged on reverse charge mechanism. And we have seen huge amount of notices under the current GST law, where they have said that whatever reimbursement you are making for the seconded employees, expat employees salary, that is liable for GST, and you have to discharge the GST on reverse charge basis for that. And many companies have paid on reverse charge basis and claimed the input credit for that. But the challenge has been for the earlier years, because the Supreme Court decision came a year back, the interest liability and penalty has been one of the issues which has been there for the earlier years. That is, however, in the context of GST. But when it comes in the context of income tax, generally the decisions have been in favor. So the question is, what is the employer-employee relationship here? there's a dual employment which is happening. Some of the tests which has to be applied based on the substance or based on the agreement which the tripartite agreement which is there in the existence is who has the lien and control over the employee, which employer who has based on substance test who can be tested as the employer. Employer is based on from whom the work is, for whom the work is performed. So for which person the work is performed. When he is in India, is he performing for Indian subsidiary or Japanese parent? If he is performing the work from Indian subsidiary, then the Indian company should be taken as employer. Who bears his salary cost? Is the salary cost taken by borne by Indian company? Then Indian company should be taken as salary. Who controls and supervises the seconded employees? So if the control and supervision reporting requirements are all with the Indian employer, then it should be taken as Indian employer is the person who should be taken as employer. So this all will depend on how the agreement of secondment is drafted. There one needs to be very clear that these tests, what are there? These tests are properly taken care. And the drafting, if you see various decisions, IDS decisions, ABI's decisions, where they have given a good amount of weightage to these particular provisions in the agreement and says these aspects like control and supervision, to whom he is reporting, who has a responsibility of work performed. Tomorrow if the employee does anything which is wrong, who will be the responsible for that? Who will be paying his salary? Who is the employer from whom the employee can recover the salary in case if the salary is not paid? Who has the lien on control over this? Lien will naturally bear, even if you look at the Supreme Court's decision in Morgan Stanley's case, the lien will be there with the parent company because he can always go back to parent company or the company outside India and do the work there. But one needs to ensure that the agreement captures these critical aspects, and lays down a proper framework to decide on these particular aspects very clearly. Any ambiguity in this will create a problem. Okay. Now, once this is done, if part salary is paid by, say, Japan in our example, Indian company makes a payment back to Japan. The question is, when I make this payment back to Japan, if applying these principles, can I say there is a dual employment, but the employer, the real employer, is still the Indian company, because Indian company is who is getting the benefit of the work of the employer. Indian company is who is paying the salary. Indian company bears the risk and reward of the employee's work. It has the risk and reward both of the employee's work. If that is with the Indian company becomes the real employer for applying the secondment test. This should be brought out properly in the agreement. If this being the case, where part salary is paid by US, at least in the income tax context, as I said, the Supreme Court in the context of service tax has said that this is a service, and to that extent you need to discharge the service tax on that, which naturally applies to GST also. But when it comes to income tax, and this after this decision of Northern Operating System also, the High Court, say Karnataka High Court in Flipkart's case, Karnataka High Court in ABI's case, and Bangalore Tribunal in various decisions has still continued to take a view and not apply the principle laid down by Northern Operating Systems, and still take a view that in these cases the salary Indian employer is the proper employer, risk and reward stands with the Indian employer, and therefore this could be as good as a reimbursement of a salary and paid, and there is no liability to TDS. There is no liability to TDS. Added point which is argued is that it qualifies as a fees for technical services. The revenues argument is the Japanese company is rendering services to India. Japanese company is rendering services to Indian company. What is the service that Japanese company has rendered? It has done only one time transfer of employees, secondment of employees. After that, it is not doing any regular employee. Once you treat the employee as employee of Indian company, there is no continuity of service which is happening in the subsequent months. It's only one time task of transferring the foreign employees. That is only one time task. Subsequently, if we are able to satisfy the test of employer-employee between the Indian company and expats, in those cases, there is no subsequent service which the Japanese company has rendered to Indian company in our example. So there is no continuing service. So the test of 917, that services should be rendered, which should be in the nature of FTS, of technical consultancy or managerial services, that may not be satisfied. Also, in cases where the treaty has added make available clauses, one could take the benefit of those make available clauses and conclude that and say that there is no make available test satisfied in this. Last point which comes is a service fee exposure in these kind of cases. Now, if one accepts the revenues contention that the employees are employee of Japanese company, then those employees being in India, their presence in India itself will create a permanent establishment. As I said, service fee, so if you look at treaties, Article 5 of treaty will define a permanent establishment, fixed place fee and service fee. So service fee based post a certain number of days, if the employee is in India and rendering services from India, that itself will create a service fee. So this issue also comes up because if there is a forced stay because of COVID, they will, being in India, that can create a permanent establishment. In secondment, if you treat them as an employee of Japanese company, that could create a service fee in India. The whole point that will be relevant is whether we can say that the employer-employee relationship it is satisfied for Indian company or the Japanese company. The agreement should cover the aspects which I have highlighted to say that the Indian employer becomes the employer, real employer, and then if we can avoid the service fee exposure also. One could refer the Bangalore Tribunal decisions in AB and ADS, very detailed decisions where all these issues are discussed in detail, and also the Karnataka High Court decision Flipkart and AB are helpful in this proposition. So these are some of the issues connected to secondment. So with this I complete my presentation. Thank you everyone for patient hearing. If there are any questions, we can take it.
Thank you, sir. Thank you for that presentation. I request Vice Chairman Pramod to hand over a gift voucher for Narendra sir. Yeah. Thank you, sir. So I thank all the members present here for the last 2 days. Hope so. The hall is even empty, but I have to, it's our duty to thank everyone who has registered for this 2-day seminar. I thank each one of you from the bottom of my heart, and on behalf of the Management Committee of Bangalore branch as well as the ICI, I thank everyone for being here. Thank you all.